The world economic outlook as we see it, as you know, the IMF had its annual meeting about a month ago, and what was very striking at the annual meetings is that we revised downward growth by a small amount, by 0.4%, but the mood at the meetings among the stakeholders was very decisively more negative than it had been in 6 months before, a year before. Why is that? Because sort of numbers coming out are showing that the recovery is much more fragile than we thought it would be. And it's fragile because of those three elements. One, the legacies from the crisis. Where do countries stand today as we're exiting the crisis? Well, they stand in a place that is not so easy, notably because of the very high weight of public debt and private debt in some countries. And this is affecting the outlook and affecting the recovery. On top of this, in terms of the short-term outlook, we see increasing uncertainties. And I will go back to these, but sort of uncertainties both on the political, geopolitical front, but also financial and real side uncertainties. And finally, this is sort of clouded by an overall worry, which is about potential growth, and where does potential growth stand, not only in Europe, but globally for the next 5 and 10 years. And this is also a real source of concern. So the first element of the outlook is there is a recovery, and this recovery is in place, and it's set to continue. So it's a very different outlook from, let's say, 2-3 years ago. Though we've revised the recovery downwards, mostly because of weaknesses in the first part of 2014, our forecast for 2014 remains at 3.3%, so downward revision, but still supported by a number of factors for recovery. But as I said, it's more fragile than we thought, and it's also more diverse, and there's more heterogeneity in the outlook. For 2015, we have a small pickup in growth at 3.8%. So let me look at some of these issues in the global outlook, some of these issues in the heterogeneity. So we have one real source of concern, which is Europe. And here, those are sort of well-known figures, but you see on the left-hand chart the difference between the recovery in the US and the recovery in the Eurozone being the red line, and you see the very wide divergence between the blue and the red line. So that's the divergence in the recovery. And if we take into account the stressed euro area countries, then it's even weaker economic performance. And this is associated with a decline in the inflation rate. Which is also a source of concern, and I'll go back to this when I'll talk about Europe-specific concerns. If we look at emerging markets, there's been a significant slowdown in emerging markets, and so the question here is, has that slowdown sort of bottomed out? Have we reached a plateau in terms of growth in emerging markets that means that risk is mostly on the upside going forward? If you look at long-term expectations compared to forecast in 10 years ago, you see that the expectations were mostly upbeat in sort of before the crisis, and recently the expectations have been really sort of trending downward. So question about emerging market. And then that's also a point that Professor Maskin mentioned, African performing relatively strongly. This is low-income and developing countries. They've experienced very strong growth. Here there's a question, how much can they sustain that growth in a weaker global environment? So with those questions, what is supporting the recovery? Well, in advanced countries, you have policy factors that are supporting the recovery, and this is one, the fact that monetary policy remains or becomes even more expansionary, the fact that fiscal consolidation is moderating very substantially in 2014, 2015, and the fact that financial conditions remain very supportive. I'm not sure I included a chart with with sort of the yields on financing conditions, but they're really supportive of the recovery. In emerging and developing economies, the support to growth comes from greater external demand in advanced economies, so the recovery in advanced economies somehow helping emerging markets. The gradual progress on the structural reform front. And the last point is the fact that so far geopolitical risks have been affecting countries, but in a very sort of country-specific manner. So there's been relatively limited spillover from this. I'm not going to go through the whole numbers, but just a few elements to outline. Maybe the difference between the US and the other advanced economies, which are modeled here with the euro area and Japan. You see growth projected to be very weak in the euro area and weak in Japan as well. And on the emerging market side, which is really striking here, is the much greater heterogeneity between countries than the one we had in the past. So not only growth rates are lower than they were in the past, but they're also much more diverse across countries, with countries like Brazil and Russia performing much weaker than India and China. What about downside risks? So downside risks have increased. We see four main downside risks. One is geopolitical tensions. The second downside risk is financial market correction. Why? As I mentioned, financial market conditions have been very supportive of economic growth with higher equity prices, risk spread compression, and very low price volatility. These trends of the last 1-2 years could reverse, and if they reverse for reasons that are not in line with fundamentals, but if they reverse because of disorderly adjustment in financial markets, then the cost to the real economy could be significant. And so we expect to live in a world where the volatility in financial markets is probably going to be greater than it was in the last year or two. Third risk, the risk, and that's more sort of a short-term risk, which differentiates it from the last risk. It's risk of stagnation going over the next few years in advanced economies, combined with low inflation in the euro area. And I'll go back to this. 4 point, which is a major source of worry, is this question of sort of secular stagnation. What environment do we have for growth going forward if we observe sort of permanent decline in potential output in emerging markets, and also lower potential related with lower investment, as was also mentioned previously. This has been confirmed by recent developments, sort of three major developments in the month of October. One, we've observed a bout of financial market correction that was quite substantial, and that's materialization of a downside risk. We observed considerably lower oil prices, and for us, this is mostly a positive and upside risk to the economy, so the realization of an upside surprise. Why? Because we feel this is mostly supply-driven and not demand-driven. Third element in recent developments, confirmation of the weakness in economic activity and the weakness in inflation. So reinforcement of the concerns on lowflation. What does it mean in terms of policies? Well, in terms of policies, I think the IMF tries to strike a balance in this debate that we have among opinion leaders between sort of those who are more on the supply side pushing for structural reforms and those who are more on the demand side pushing for demand support. Our point of view is that demand support remains extremely important with large output gaps, large levels of unemployment. And this could go through, as is shown here in the slide, through a boost in public investment as sort of a key channel to boost economic growth. But this would not work on its own and needs to be associated with structural reforms. And the demand support opens a window of opportunity for these structural reforms that needs to be taken. For emerging markets, policies are making sure vulnerabilities are addressed, and the room for policy responses is much more limited now for emerging markets than it was prior to the crisis. So this is a very important point. And then, again, structural reform to increase potential output. Okay, those are more specific policies. I'm going to skip this in the interest of time to go to Europe. I think we can focus on two key elements. One is sort of the very low growth performance associated with low inflation. Let's look at a few charts. So we have financial conditions in the euro area that are improved very significantly over the last 2 years. And basically the situation here has been helped by strong policy actions. So maybe in contrast with the more critical view of the policy stance that we heard before, I wanted to note some good policy actions that were taken in the Eurozone. The creation of the financial firewall, the assessment, the comprehensive assessment of the situation of banks, the expansionary stance of monetary policy, progress towards banking union, some refinements in fiscal governance. However, and that's where I'd be very much in agreement with the previous speech, much more needs to be done in all those fronts. So let's look at some slides that give us a sense of this vulnerability in Europe. First, this is the recovery. So the yellow dots are the growth rate. You see that the recovery is recent, and it's also not very strong and trending downward already. It's been supported by a return of domestic demand, but that return has also been very elusive. So first source of concern. Second source of concern, we've talked a lot about regional rebalancing. So one of probably the important factors behind the euro crisis has been very strong regional imbalances with deficit countries experiencing loss in competitiveness, deteriorated fiscal balances, etc., while you had countries generating very large surpluses, such as Germany and the Netherlands. These positions have reversed, and that's what you see at the bottom. So countries, Italy, Spain in the light blue, other debtors of the euro area, and the program countries in the darker blues, those positions are now sort of closed. Those deficits are almost closed, which is a positive development. What is less positive is that this adjustment has been very asymmetrical, and there's been no adjustment on the part of surplus countries, which basically creates a deflationary environment in the Eurozone, which for us is also a source of concern. This is combined with low inflation. And here we see the trend in inflation. Low inflation is becoming much more broad-based, so affecting a very broad number of countries, and also broad-based in terms of the items that it's affecting inflation. So it's not just a drop in the oil price driving low consumer prices. It's really even core inflation going down significantly. Why do we worry about low inflation? Well, because debt is very high in the euro area. And we are quite familiar with sort of the red part of that chart, which is public debt. And you see sort of on the public debt, we have the usual suspects, Greece, Italy, etc. But when you add sort of private debt, both corporate and household debt, you see that the problem of debt is quite widespread through Europe, and there is really a question on the private debt side. Last year, for the World Economic Outlook, we had looked at the interaction between public debt and private debt, and the finding was that the drag on growth is much greater when public debt is combined with high private debt. And this is very much what we're observing in Europe. And the relationship with inflation is a direct link to the fact that it's much more difficult to deleverage in the context of low inflation. I think that maybe the final slide on sort of the diagnostic or the concerns in Europe, the question, well, no, the one but last slide, question of investment, and that's a point that was made quite strikingly. Here we have levels of investment comparing with the pre-crisis level, and you see that on average in the euro area, levels of investment today are 20% lower than they were previous to the crisis. So we really have an investment issue that has not recovered in the post-crisis period. And this is again combined with high unemployment. So all those are factors that sort of compound themselves into creating an environment for low growth and difficult recovery. So with this, what is our policy recommendation? Well, it's a bit in line with the one I said for the global economy, but with a greater focus on demand support. And here, so the ECB has taken action, but we've been very supportive for more action and potential move to quantitative easing. Mending balance sheets is very important, notably to restore the bank lending channel in the euro area. And fiscal policy, here, our assessment is possibly consolidation was needed and was well achieved, but today we should be very careful not to add to lack of demand by further fiscal consolidation.